August 1, 1990. Real Estate Capital Basics, Hybrid Structures. During the past several decades, inflation whittled down fixed-rate mortgage portfolios burdened with below-market rates and terms. At the same time, property owners enjoyed favorable leverage and substantial profits for increasing property values. As a result, funding sources unwillingly provided financing terms insufficiently benchmarked to inflationary cycles. Thus, hybrid financing structures were devised to provide affordable combination of debt and equity funds to the borrower while simultaneously offering inflation protection and upside profits to the funding source. Hybrid funding structures cover the range of capitalization options falling between pure debt and equity. Hybrid fundings will include debt and equity features within the capital structure. Since such fundings are hybrid as the name suggests, countless legal and economic variations create multiple financial instruments. Yet, hybrid funding vehicles will commonly share the following features. Financing instruments governed by the sponsorship and capital ownership objectives, for example, taxable versus non-taxable entities, development fees versus long-term hold, project-specific issues, for example, multiple phases, and appropriate legal format, for example, loan versus equity contribution. Funding instrument behave like debt for minimum returns and equity for capturing maximum upside and inflation protection. Base rate and overall yield serves as a minimum, unsubordinated return on capital. Some form of debt and equity combinations that offer supplemental profit in addition to the minimum return on capital, subordination is optional. Where available, income participations which are typically calculated annually are combined with reversionary profits. Term of 3 years or more common as sufficient timelines are necessary for value creation. Hybrid funding structures often use varying terminology for sharing cash flow and reversionary profits including participation, sale-leaseback, kicker, supplemental, add-on and bonus to name a few. The differences relate to financing and legal implications, whether debt or equity, and how the parties classify cash flow and reversionary profits. For practical purposes, all terms and conditions somehow lead to capturing additional profits relating to project performance. Cash flow increases and property appreciation are the major incentives for structuring participation mortgages. The net operating income pro forma is therefore the most important financial measure for gauging upside potential on an annual basis over the loan term. Over and above external market factors affecting cash flow, tenant profile, credit quality, lease term, rent bumps and renewal provisions substantially influence income. Credit and prestige tenants shape the quality of the cash flow for most commercial properties. Credit tenants also have more favorable expense arrangements. While such tenants generally pay the lowest rents, their drawing power creates critical mass for smaller non-credit tenants to generate more profitable cash flows. Credit tenants should have longer-term leases of 5 years or more, indicating more income stability. Lease maturity timelines are staged to prevent rollover risk characterized by a disproportionate percentage of space available for lease renewal during any given year. Otherwise, ownership is at a negotiating disadvantage as the rent roll is out of balance and more aggressive pricing results for the tenants. And while credit tenants are recommended to have longer leases, smaller tenants with riskier credit typically stay on shorter lease terms. Upon expiration, renewals optimally offer rental rates slightly below current market figures as tenants have less reason to relocate and avoid additional costs such as leasing commissions and re-tenanting costs. As with any other financial investment, cash flow and reversion profits are not guaranteed in hybrid structures. For instance, the borrower may not be required to pay cash flow overages if distribution levels are below minimum profit thresholds. Other instances include gross income formulas burdened by unanticipated expense increases, eroding market conditions and numerous other factors beyond direct control of sponsorship. Funding sources and developers negotiate countless variations of income participations and reversionary profit formulas within hybrid deals. More complicated, creative provisions require sophisticated administrative depth along with additional legal, consulting and other services. Such added expertise expands beyond the initial underwriting talent to include asset management, loan servicing, accounting and appraisal expertise able to accurately judge economic performance and recommend optimum profit targets. Seasoned developers, public and private institutional owners and select other borrowers with sophisticated expertise desiring maximum leverage and risk sharing will seek hybrid fundings. These types of sponsors typically develop new projects or acquire opportunistic properties featuring enough upside potential above and beyond existing, stabilized cash flows. Entrepreneurial pension funds, insurance companies, Private and public syndicators favor hybrid structures because attractive medium to longer-term investment development and acquisitions opportunities abound in addition to core investments. These funding sources are patient with a strong understanding of risk. Although hybrid funding structures are available in numerous formats, the most popular include a joint venture, participating mortgage, convertible loan and land sale/leaseback.